Yeah, sure. Okay, sure.
Sure, give me 1 second, I'll check.
Okay. Thank you for having me here. So, just to give a brief idea of what I do. So, my role is to build and acquire ultra HNI clients, high net worth individuals. So, for instance, if an investor tells me he has X amount to invest, I'll then guide him with how and where he should be investing this amount. So that is my entire role. So I look after investments in equity. Equity is stock market investments, fixed income, derivatives, alternate assets, gold, and just try to present the portfolio, understanding the risk and reward expectations of the investor. So today the agenda of the session is to just demystify a lot of these concepts that we see. Once you switch on news channel, financial news channel, there's a lot. There'll be red entries, green entries. This is making new high. That is making new low. So it is all too much for us to comprehend at first. So the session for today is just to understand these jargons, try to understand the meaning that they present, and build a strong foundation so that once we go home, get back from the session, we can work on it and try to understand more about what a stock market is really all about. Sanju, is this screen visible? Great. So investments. So investments are nothing but there is an input of time, efforts, money involved. So let's say if today we decide to buy a property. So we will search for the best property in my 5 kilometer radius, 10 kilometer radius. I'll then see what is the cost of that property, and I'll do my research. I'll use my internet. I'll talk to some agents. So there is an input cost of time, money, resources, efforts. So when you have so much input involved, the output is the profit that you generate. So this is the definition for investments. However, if you talk to your relatives or friends, you would note that the investments that they make generally they don't make any profit on that. So investments has a lot of opportunity cost involved. So what is an opportunity cost? So let's say today we are buying building number A, flat in building number A. We are foregoing lot of other opportunities in the adjacent society, which could have been at a better valuation. So that is the opportunity that you are foregoing, hoping that the investment that you are making today generates higher return. So always remember this is very important even before you start investing that you should make profit. So once you have this idea in mind, then you will be able to not probably make a lot of mistakes. So why to invest? So today the average age in India is around 31, 32, and we are a very young demographic country today. Then, few generations back, when we spoke on investments, the one thing that people generally did was buy gold, buy real estate. When if you ask your parents, your relatives about their investment plan, their retirement plan, they'll probably tell you that they have bought some shops, they have bought some flats here and there. But the yield, the profits that you can generate from these asset classes is diminishing. So inflation is increasing. So there is an opportunity cost involved when you're investing in real estate, when you're investing in gold, you're going to forego a lot of other high generating returns in equity. So why to invest is, let's say today you have 100 rupees at your disposal. 10 years ago, if you wanted to buy something for 100 rupees, you, the quantity of amount that you receive today vis-a-vis 10 years ago, today it will be less. So if you talk to your parents, they'll tell you, when I was at your age, I used to get so much, my salary was X, your salary is 10X today. Still, you're not able to save and build a fortune for yourself. The main reason is inflation. So investment is very important, are very important to keep pace with inflation. And what is a financial goal? Financial goal is something which is tangible, realistic. So financial goal cannot be I want to become a billionaire. I want to become a millionaire. Financial goal could be I am making, let's say, 1 lakh a year. In 3 years, I want to buy a 50 lakh house. So you have a goal in your mind that I want to buy some product worth of 50 lakhs. My cash flow is today 1 lakh per month. After saving expenditures, everything, I'm able to save, let's say, 70, 80,000 a month. So I know in a year, I'm able to save around 10 lakhs. So I need uh, this amount of financial plan. In order to achieve this financial plan, I need to invest somewhere. Reducing taxable income. So, under ATC income tax, there is a provision of, let's say, you invest 1.5 lakhs in equity linked saving schemes and NPS, you are able to claim benefits in tax. So, to reduce the tax, investments are very, very handy. Planning for retirement. So, like I said, the average age today for working is going to reduce, and going forward it will reduce because automations are going to come up. The entire manufacturing automation industry is having a lot of drastic changes. Companies like Newbee works. The reason why they have come up is to keep the pace with the changing need of the industry. So what colleges and schools prepare you is not something that is very, very theoretical and not something that is of much practical use. So a lot of that is changing, and workforce is being replaced very, very fast on a very rapid pace. So in order to make good use of your money that you're earning today, you need to invest it somewhere in a better avenue, so that when you retire, you have sufficient money at your disposal to take care of remainder of 40, 50 years that you have to live. So my personal take on investments is, so generally, what people try to view is savings is equal to income minus expenses. What I think is investments is equal to income minus expenses. Here, generally, people have the income part in this equation is fixed, and investment part is variable to a lot of people. What I suggest to you is, from today going forward, you need to have this investment amount fixed. Income amount is fixed. Let's say you have a salary of, let's say, 100 rupees. So 100 is fixed. You need to first decide I want to invest, let's say, 20 rupees. So your expenses should not exceed 80 rupees. So then you need to backtrack and say, okay, what are the expenses that are really required? What is something that I can forego? I'm not saying live a frugal life and don't, enjoy your life, don't party, do all of that. But see which really how you want to manage that. If something can be foregone, then definitely try to do that. A quick example, I'm sure many of us would know about Warren Buffett. Warren Buffett, till the age of 61, was a millionaire. The main money, major part of his money that he made today is amongst the top 10 billionaires in the world, is post 60 years. So, how did he make money after that? Is because of compounding. As and when, so the more period that you spend invested in your portfolio, the higher the returns that you can generate. So, in order to make real money in stock market and in your investments, You need to start really early and balance your income minus expenses very very early. So that once this is done, then your investments part will increase and you'll really make good money in stock market. This is more mathematically driven rather than just gamble. So a lot of people view stock market as a quick rich scheme or get rich scheme, but it is not that. It is all about how you manage your expenses, how you manage your income, how you plan your financials, how you plan your goals. What is something that is really on priority for you today, and accordingly you can do investments and make money. So when we talk about investments, there are so many things that we can do. We can invest in gold, we can invest in real estate, we can invest in commodities. We could buy a house, we could buy a car, we can do all of that. But remember, when you're buying a house, or that is highly illiquid. When you're buying a car, the minute you take your vehicle outside the showroom, the vehicle is depreciated. So let's say you bought a car for 10 lakh rupees. Once you take it out of the showroom, and let's say you want to return it to someone else or you want to sell it, you cannot sell it back at 10 lakh rupees. You buy a mobile, you cannot sell it back at buy it at 10,000, you cannot sell it back at 10,000. So why to invest in equity is equity as an asset class is highly liquid. So what do I mean by liquid? So let's say I want to buy Reliance Industries today. I'll just go to Google and see what is the price of Reliance. I'll switch on my TV. I'll talk to my broker. I know the price of Reliance. I want to sell it tomorrow. I can sell it tomorrow. So that is all about liquidity. If you buy a flat in Cochin, if you want to sell it tomorrow, it cannot happen in 24 hours. There's a lot of paperwork involved. You need to have the right buyer, right seller, right price. Agent should be supportive. Lot of rules and regulations involved. So equity as an asset class provides the highest degree of liquidity. And equity is very very easy to diversify. Let's say today you have 10,000 rupees to invest. You can invest this 10,000 rupees in 10 shares. If you have 10,000 to invest, you cannot buy a flat. You have 10,000 to invest. At max, you'll be able to buy 2 grams of gold. So, hence, equity is very, very easy to diversify. It has amongst the lowest transaction fees involved. If you want to buy something for 10,000 equity, after all the cost, at max, you would be incurring 4 to 5 rupees as transaction fees at max, and it helps in building a higher risk adjusted return and managing your retirement account. What are the cons? Cons is it is very very volatile. So if you have been following stock market for the last 1 year, you would have seen that the market from in March went as low as 7,500. Now it is near 15,000. Pre-COVID and post-COVID scenario, a lot has changed. However, the Indian economy has actually faced a lot of turbulent times during COVID, and now it is on the verge of recovery. But the stock market has had a correction of 50%, and now is up by 100%. So it is very, very volatile. There are some stocks which have sideways movement. What is sideways? Sideways movement is nothing but there will not be any price appreciation or depreciation. It will be range bound. 100 rupees, 120 rupees, 120 rupees, 80 rupees, 80 rupees, 100 rupees. So there is no proper movement there, and you will not be making money. And there is a lot of scope for emotional investing. If you talk to your parents or your relatives, someone who has been investing in stock market, and you ask them why you have invested in this stock, they'll come up with some theory, and if you just keep on questioning, you will see that they are emotionally invested in the stock more than rationally or logically. They are emotionally invested, and hence there is scope for losses, and there is scope for, let's say, if someone is an employee at Reliance and he is buying Reliance share, that doesn't mean he has done his research. Maybe he has done his research or maybe he has not, but he is definitely investing emotionally. Some stocks could actually be very famous and could be household names, like Tata Motors or State Bank of India, um, Infosys. And if you randomly invest in these shares anytime at any level, without really doing some research, you'll definitely make not be able to make much money there. And selling stocks, like any other asset class, has a taxation involved. However, the taxation part is less, but still significant. So, what is a stock market? So, stock market is a place where you and I could go and transact. You are a buyer, I am a seller. I am selling one share of Reliance Industries. You are buying one share of Reliance Industries. Stock market is an avenue which is a marketplace letting you to buy and letting me to sell. So this is all about stock market. In very simple terms, it is just a means to buy and sell equity shares. For all for all practical purposes, we can say if stock market is not there, you'll not be able to buy Infosys or sell Infosys in the stock market. So stock exchanges like NSE, BSE are are providing that platform for you and me to buy and sell shares. So Bombay Stock Exchange is one of the fastest stock exchange in the world. National Stock Exchange is one of the biggest stock exchanges in the world. They are driving the fintech revolution in India and trying to make a lot of these processes digital. Intermediaries in stock market. So stock market intermediaries are agents or are entities which are between you and me when we are transacting in stock market. So a stock broker. A stockbroker is an entity who is used to buy or sell shares. So, full disclaimer: I'm part of Motilal Oswal Group, and we are a stockbroker. So, let's say you want to buy one share of Reliance. So, you will call up Motilal Oswal. You will open an account with us. You will then tell us you want to buy one Reliance share. We will then go to NSE or BSE. We will buy one share and transfer it in your account. This entire process today is completely digital. Then there is depository participant (DP). 20 years ago, one share that you used to buy had a share certificate in a physical form. There was a physical document that you need to carry in order to buy or sell shares. Now that process is completely digital. You will be able to see the quantity of shares that you are buying and at what rate, thanks to your depository participant. Clearing corporation is an agency entity which is settling the trades. I am buying one Reliance share. I am giving 2000 rupees. And this 2000 rupees is getting transferred to the person who is selling Reliance, and from his account, one Reliance share is being transferred to me. This action is being taken by the clearing corporation. Banks provide the much required liquidity to help individuals like me. If I want to buy one Reliance share, they'll give me the capital to buy one Reliance share from my own bank account. And once you have sold this one Reliance share, this amount that goes to your clearing corporation, then it goes to your depository participant, then to your stockbroker, and then it goes to the bank, your bank account. This is the entire process. Indian capital market, the stock market. So, can any one of you tell me what an IPO is? Initial public offering. You would be reading a lot of these news saying this company has come up with an IPO, that company has come up with an IPO. Is can anyone just give me a one liner about what IPO is all about, or what their understanding of IPO is? Okay, so IPO. Let's say tomorrow, Newbie Works wants to raise capital. So what can Newbie Works do is they can go to a bank, ask for 10 lakh rupees. Bank will say the current rate of interest is 13%. Newbie Work agrees. So cost of capital when you are trying to take a loan is 13% in this case. If new Vivek goes to an individual, let's say new Vivek goes to Sanju saying, Sanju, give me 10 lakh rupees. Then Sanju will charge some rate of interest, or there is an exchange of, some contract saying, you meet so much obligation, I'll then make X amount of money. So again, there is some cost of capital involved. So a lot of these companies try to source funds from banks, from agencies, from individuals, from HNIs in their early stages of their businesses. Once they reach a certain point, the cost of capital is substantial if you are raising it from individuals and banks. Like I said, 13%, 10%, 15%. So that is the rate of interest that you have to pay. 7%. And for 10 lakhs, 7% is not a very big amount. It's not too much. However, once this 10 lakh becomes 10,000 crores, when you become a scale as big as, let's say, Reliance Industries or Infosys, if you want to take money from individuals or from banks, even a 5-7% rate of interest actually eats into your profit margins. So what these companies do is they go to the stock market, then they say, I want to give 100 shares of my company in exchange for 10,000 rupees. So I'm valuing one share, 100 shares as 10,000. So one share is 100 rupees worth, is what my proposal is all about. And they then list the share in the stock market. So this is the entire process of IPO. Reliance Industries wants 10,000 rupees. They say, I'll give you 100 shares in exchange. I want 10,000 rupees. People like you and me say, okay, I want one share. I am ready to pay 100 rupees. So the beneficiary in an IPO is the company that is wanting to come up with an IPO. So in the primary market, this is the primary market where in IPO the beneficiary is the company. Once they receive their 10,000 rupees for 100 shares, their job is done. They get their money. They use this money for working capital for building their business. Then people like you and me who have bought these shares, we are holding it in the secondary market. 100 rupees, if it goes to 150, if it goes to 180, if it goes to 1000, someone would want to sell it. Someone would want to buy it. People who did not get it in the IPO, who did not buy or did not get the allotment, would want to buy it at 200, maybe want to buy it at 50 rupees if it falls down. So this transaction, this activity takes part in the secondary market. So quickly, companies come to the stock market to raise capital in exchange for equity, to source it from individual finance in exchange for equity shares. That, I would really like to understand from any one of you, if you would like to tell me what is the cost of capital in this case. Yeah. Okay. So uh, I'll, I'll 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 just give another example. Here, if you are taking a loan for 10 lakh rupees, you need to pay some interest. When you come to stock market and you're listing your shares, you're not paying any interest, right? So the cost of capital in an IPO route is, for all practical purposes, interest free. So the main agenda why companies come to stock market to get their shares listed is to gain access to interest free capital. All right. So there are multiple avenues to raise funds: equity, debt, or mixture of both. In equity, the interest rate is the cost of capital is negligible, almost equal to zero. Debt is where the company says, I want 10 lakh rupees, I am willing to pay 7%, 8%, 9%. Hybrid is a mixture of both. SEBI is the entity who is the watchdog who looks after all the intermediaries and the market participants and ensures that people like you and me, retail investors, are not cheated and are able to gain access to their funds regularly, are not are not facing any difficulties, and make sure that the entire process is very smooth and very simple. So there are a couple of market participants. Credit rating agency, yes, CRA. Credit rating agencies, their role is to ascertain the credit worthiness of a company. So Reliance is wanting to raise shares. So how would you know whether or not to buy these shares, or what to do about these shares, whether to buy or not to buy? Credit rating agencies come up with their own rating matrices. They then rate the company based on the financial metrics, and then they come up with a credit rating. Credit rating is used by you and me to analyze the financial strength and decide whether or not we want to purchase. Corporates, companies come to market to raise capital, to sell their shares, to buy shares. Intermediaries like brokers, investment banks, stock exchanges, your clearing agencies, depository participants are all intermediaries, and they work in tandem with everyone. Individuals like you and me are the market participant. We buy and sell shares. Banks provide the much required liquidity in the stock market. Foreign investors, foreign direct investors are foreign institutions which are investing in Indian stock market. So index, you would have heard about Nifty, you would have heard about Sensex. So what is a stock market index? So a stock index is nothing but a weighted average, sorry, a stock index is nothing but a weighted average unit, a measurement of a basket of shares. So let's say if I'm looking at investing in Reliance or investing in TCS, this and I could also analyze the performance of Reliance and TCS with some benchmark, right? So let's say uh, I want to I want to purchase one X units in an IT company. If I want to analyze the performance of this IT company, I would want to compare it with something else. So this something else could be a performance of average performance of all IT companies in India. So that is an IT index. So you compare performance of Infosys with that of IT index. You compare performance of Infosys with that of the top 50 companies in the market. That is nothing but Nifty. You compare performance of Infosys with the top 30 companies in the market, nothing but Sensex. So Nifty, Sensex, Nifty 50, BSE 100, FMCG, IT, these are all sectors or industry indices, benchmarks, which are nothing but a weighted average performance of the stocks in the basket. So they enjoy some percentage of allocation in the index. So that measurement is all taken by the market regulators. So imagine a class of 100 students. So if you want to measure your performance, you will probably then see the so so how would you say, let's say you scored 50 out of 100. So if you want to justify the score to someone who is probably talking to you who doesn't know about your school or college, he would probably first want to understand the average performance of the batch, who is the topper, what is the passing percentage, and then judge whether 50 out of 100 is good or bad. Similarly, index is that barometer. Index is that benchmark which you can use to measure the performance of the market and individual stocks. So you would have heard these terms like bull market, bear market. So just look at this image. A bull by default attacks its prey heads on. So if you look at the horns, it attacks its prey standing on its feet heads on. It pushes its prey into the air. So bull is a market where things go in upward directions. A bear attacks paws down. It hits its prey heads down. So bear market is a market where the market moves in the downward trajectory. So in Hindi, in India, we use the terms tezi and mandi. Tezi is where it goes up, mandi is where it goes down. So you would have seen NDTV, Profit, CNBC, Awaz. You would have seen news channels where there is a lot of green tickers, stock prices moving left to right. There is a lot of numbers and very difficult to understand, comprehend. It's actually very, very simple. So ITC, Indian Tobacco Company, they are a major manufacturer of cigarettes and FMCG goods. So you would know about Ashirwad Atta. You would probably in this COVID you would have used Savlon sanitizer. It's all manufactured by ITC. Mega giant based out of Kolkata, West Bengal. So ITC, uh, if you look at this price at the time the screenshot was captured, it was trading at 217.45. 217.45. Stock market timings are 9:15 to 3:30. So when the market opened at 9:15, this stock started trading at 225. When this screenshot was captured, this stock traded at 217. So it is trading lower than its opening price. Again, it is trading lower than its opening price. Since it is lower, it is denoted by minus sign, loss, and in red color. 52 weeks, and it the lowest rate that it went for that day was 215. The highest rate that it went for that day was 225.95. That is, the rate at which it opened was the highest price, and after that, the stock fell down. What is the percentage loss? 3.97%. This is all about the stock ticker. ITC is the uh, code, NSE code for stock ticker, ID for you to identify the stock's name. 217 is the share price. There has been a correction or a loss of 3.97%. In a year, in stock market, we have 52 weeks. So 52-week high is the data of the highest price for the share in the last 52 weeks. That is in the last 1 year. So if I'm talking about 52-week data for the 7th of March, this data will go back to as before as 8th of March 2020. So the past 1 year, 239 was the highest price for ITC. The past 1 year, 134 was the lowest price. So these numbers could act as a range. So in 1 year, the stock could go to as high as 239, could go to as low as 134. It is at 217. So you could say it is near its 50-week high. So maybe on the price action, you could say it is having some stability near high, so it is not in much profit. Maybe. Now, this section is probably not much required for your day-to-day normal analysis, but you could just look at the share price for starting and understand this its performance with regards to its opening. Adani Ports opened at 592. At the time of the screenshot, it was trading at 616. So it is above its opening price. It has moved up. It has had a positive movement of 4.24%. Hence, it is denoted in green color. It opened at 592, went up to as high as 621. It is trading at 616. It made a low of 586. 621 was the highest price it raised in last year. It is trading at 616, so just 5 rupees shy of 52-week high. It was as low as 203 for the last 1 year. So I can safely say it has moved 3 times from its 52-week low. Correct? Now, this is the chart of Nifty. Nifty 50 is what we just discussed a couple of minutes ago. Nifty 50 is the weighted average of top 50 companies in the stock market. So, this is the graph that I've plotted for 1996 to today. So, green entries are where, if you recall Adani Ports, it has made a green entry. That means it has opened higher than it is at a higher point than its opening price. Red means it closed at a low and than its opening price. Similarly, here if you see a green entry, that means it opened here, went up here. You're seeing a red entry, it means it opened at this level around 11,300 and went low here, opened here, went here, opened here, went here, hence green. So I'm hoping that this point is clear now. If not, please stop me anytime in the presentation to ask your queries. So we are just trying to understand how Nifty or how our stock market has performed. So at 1996, markets measure is 1,000. Today it is at 15,000. So in 25 odd years, the market has moved 15 times from 1,000 to 15,000. So in long term, would I be safe to assume that once you're investing in long term, above 5 7 years, you are bound to make money in the stock market because the quality of companies that we have in India are making new highs. There are a couple of major events that have happened in the last 25 years which have caused market to correct. So in this graph, you would probably be able to point out 4 to 5 areas where the market has corrected significantly. One would be here, 2000 crisis, where you had the dot-com bubble in US. Markets had crashed there, hence there was a ripple effect here. Here, markets fell down because of the fall of uh, Atal Bihari Vajpayee government. Here, markets had crashed because of 2008 global financial crisis, uh, where Lehman Brothers got bankrupt. A lot of companies got bankrupt. There was a subprime mortgage crisis. Here, can anyone tell me what happened in 2016? Yeah. So, guys, participate. Or else, stock market is really interesting. If you don't participate, don't try to discuss. Not probably get huge insights. So, in 2016, we had demonetization. We had surgical strike, right? So, markets corrected. So, what happened here? 2020. Yeah, anyone? So, 2020, we had the Corona crisis. So that resulted in the market to crash. So in 25 years, we have had 4 to 5 events where market has crashed. However, if you just look at the underlying theme or take a bird's eye view of the analysis, you would see that market has had a linear upward growth. It has had a correction few times, but in the long run, so let's say if you're invested at the high 2008 high, by 2013, 5 years you would have made, it would have not have mattered. You would still have made money. You would have invested at the high 2004. By 2006, 7, you would have started to make money. By 2004, Nifty was at 2000. 2008, Nifty is at 6,000. So index has moved 3 times in 4 years, 6 years. So in long term, you'll always end up making money, provided you are sticking for the more than 5 years horizon. Most commonly used jargons are 50-week high and low. So, what is 50-week high? The highest share price of the stock for the last 52 weeks, for the last 1 year, highest price the stock was trading at is the 52-week high. 52-week low is the lowest price, is the lowest rate at which the stock was trading. It is 52-week low, all time high. So, all time high for Nifty is 15,000 plus. All-time low for Nifty would be 1000, right? 52-week high for Nifty would be the rate it was trading between March 2020 and March 2021. So it would be here. The lowest price would be 2020 March, somewhere here, 7,500. So 52-week high is the highest rate for the last 1 year. All-time high is the highest rate since inception. Long and short. So let's say I'm taking a long position. That means I am buying a share. That means I'm positive in a share. So today, let's say if you want to invest in Reliance, for example, that means why do I want to invest in Reliance? I would probably have read some report, or I would have seen some news, or gone through some clippings where I'm confident that the company is doing well and there is something new and exciting happening in the company for for it to cause a share price spike, for it to appreciate in price. So I am buying, I am going long. That is buying a share. When do you go short? Short is when you are confident of price depreciation, where you are confident that the share price will fall, where you are confident that the information that you have or the research that you have read points to the direction that the company's rate will fall. Then you are taking a short position in the stock. Target is, according to your analysis, the rate at which you feel the company would be fairly valued. You're buying it at 100. You're buying one stock at 100 rupees. You should then decide at what rate you would want to sell it, at what time, what is the maximum risk that you are willing to take. The maximum risk is nothing but stop loss. The reward that you're expecting is target. This risk and reward is analyzed and we come up with these numbers after proper research. We then look at the balance sheet, the numbers, look at the management commentary, look at the industry, the support that it has, the government initiatives, how long will it support the company's performance, and then come up with a target. And we assess the risks involved, the competitors involved, the competitors' products, what could happen to the stock price due to certain events. We then come up with a stop loss. An intraday trader is someone who is buying a share today at 9:15 and selling a share before market closure 3:30. So an intraday trader is someone who is buying and selling or selling and buying on the very same day. A positional trader, a positional investor is someone who has bought today and not selling today. He may sell tomorrow, he may sell 3 weeks from now, 3 years from now, 30 years from now. He is someone who is holding the share. So, how do you make money in stock market? Is you'll make money when the share price appreciates, right? You have bought a share at 100 rupees. How do you make money? You'll make money if the stock in 10 years from 100 goes to 1,000. You have made a 10x return, correct? So, what has to happen for your share price to appreciate? If you have understood that, then you'll probably make money, correct? So, a lot of things need to happen. One thing is, if for the best part of 10 years, company is coming up with no new products, there is no growth driver, there is no interesting or exciting thing happening, for all practical purposes you can say you'll not be making money in that company. So till 2015-16, better part of last decade, Reliance had not made any money for their investors. But after the advent of Geo and digital revolution brought by Reliance, company has scaled great heights. It has made 4x return for their investors. 400% is 4x. So what needs to happen? The company should have new growth drivers added, should have new products, it should increase their market shares, keep on working on better products, better service offerings, have to be investor friendly for share price to spike. The product that the company is selling has to have huge demand. The company should have proper support from the market and its peers. The trend is nothing but the requirement or the supply and demand cycle for the product. So let's say if you're manufacturing a product, however, hardly 1% of the Indian population uses, and once you have reached the 1% population, you're not very sure whether you have reached the maximum target population. If that happens, the odds of you growing your organization reduces. And if your organization doesn't grow, share price will also not grow. So the company should have proper tailwind support, should have proper trends involved. It should enjoy huge capital liquidity for it to grow, acquire new businesses, build new plants. The market sentiment should also be positive. So let's say, for example, Newbee works. If they start a new business next year, and next year we have another scenario like COVID. However strong the business could be, a scenario like COVID will result in a huge negative sentiment in the market, and in all probability, the product that Newbie offers could also not make much money, and hence the share price of Newbie will also not make much money because the sentiment overall in the market is negative. Most commonly made mistakes by investors. So we'll most number one mistake that I've seen investors do is buying companies that they have heard. So buying companies like State Bank, TCS, Infosys, Reliance, HDFC, ICICI, just because you know the company's name. I'm not saying these companies are bad. They're all phenomenal, great, huge Indian companies. However, buying them at any rate, at any time, just because you know the company's name is the number one mistake that a lot of investors do. Should buy a company when you know there is something new and exciting happening in the share. So back to my slide, first point. New product, new management, new pro driver, new service offering. Something new and exciting should happen for it to appreciate in price, right? For example, Tata Motors coming up with a new, impetus focus towards electrical vehicles. Reliance coming up with new product offerings in Reliance Retail, Reliance Digital, Reliance Geo. So something exciting has to happen for the share price to spike. Another common mistake is not booking loss. So I would want to take just a quick question here. Let's say let's say you invest in a company at 100 rupees and the company has made 50% profit, right? From 100, if it has made 50% profit. Uh, Sanju, if you could tell me the price um, of the share currently. You're invested at 100, it has made a 50% profit. Perfect. So now you're investing in another stock, you have made a 50% loss. So what would be the price then? So that is the most common mistake that investors do. Okay, so you've bought a share at 100, it has made a 50% profit, the share price is 150. Now you're buying another share and making 50% loss. That means the price has depreciated by 75 rupees and not 50. Correct? 50% of 150 is 75. So now you have invested 100, you make 50% profit, it is at 150. Right, sir. And then you make a 50% loss, it is at 75. So now, in order to break even, that is, go back to your 150, it is no longer a 50% profit. Ask. You need to make 100% profit to break even. So, as and when your increases, as and when losses increases in the portfolio, the the requirement for you to generate returns also increases exponentially. It is no longer a linear graph. Losses mounts, the degree of returns that you need to be generating increases exponentially. So if you have a 90% uh, correction in the portfolio, you need to have 900% profit to break even, and that is impossible to achieve. So the most common mistake that investors use generally do is also not booking losses, getting emotional, keep buying shares at when they are falling. So there is an example of company like Yes Bank. It was at 400 rupees. Today it is at 16 rupees. Right. So there has been complete wealth erosion, and still you will find people, relatives, your friends, family, still buying Yes Bank at every falling rate. They have not made money. Why? Because they are emotionally invested. So in the long term, why investors have actually made money is because of this eighth wonder of the world called as compounding. You have 10,000 rupees. In 3 years, if you generate 15% return, 15 threes are 45, correct? However, in 3 years, you would end up with a 52% profit and not 45%. This extra 7.2% that you make is thanks to compounding. In 15 fives are is 75. However, in 5 years, you would double your money. 10,000 becomes 20,000. This extra 25% that you make is compounding. 10,000, 15%, 15 tens are 150. So the 10,000 should in 10 years be 250%. But no, with a 15% return in 10 years, you would have four times multiplied the portfolio value. So investment money is made hugely thanks to the magic of compounding. So major money is made after sixth year, because that is when the graph goes from being linear to exponential. So just in 5 years, you had doubled your money. In 10 years, you had quadrupled your money. In 20 years, you would have made uh, 25, 30 times return. So that is the entire stock, mantra to gain success in stock market. So buy right, sit tight. Buy good companies, hold it for long term. Do your research, do quarterly reviews, and you'll be able to make money. That's it from my side. If you have any questions, we could take. Yeah, great. Sure. Sure. So if they have any questions, they could also connect to me on LinkedIn, or they could post it to you, and you could then have a follow up session with me. Yeah, great. Sure. Sure. Thank you. Pleasure is all mine. Thank you for the invite. Wish you all the best for your endeavors. Thank you.